I want to talk to you about your freedom. In particular, I want to talk to you about your financial freedom. Are you saving money? Are you investing your money? Are you actively trading stocks, options, futures? Are you doing the necessary things to help grow your wealth? Me personally, I trade options. I love trading options. Trading options has really helped me earn a little extra income myself. I've been trading options for a number of years. I make thousands of options trades every single year. Now I know what you're thinking. Options, they're too risky. They're too complicated. It's too difficult to learn. Nonsense. Let's talk about risk. Options are as risky as you choose to make them. If you want to take on more risk with options, you can. If you want to take on less risk with options, you can. So you choose your risk level with options. And as far as it being too complicated to learn, that's nonsense as well, because can you learn how to play certain games like chess or poker, right? Those are games that, you have to study a little bit. It takes some learning. There's a learning curve to learn those games. And when you play those games for the very first time on day one, do you sit down and play somebody at chess or play somebody at poker and expect to beat them if they're a good player? No, right? You're a total noob. There's no way you're going to beat the good guys, right? The good players, right? You can't compete with those kinds of players just yet. It's the same with options, right? It takes a little study and it takes a little time. You have to practice your craft a little bit. But is it complicated in the way some people think it is? No, it's no more complicated than many games that people learn to play. If you can learn how to play chess or you can learn how to play poker, trust me, you can learn how to trade options. My favorite option strategy is called the wheel strategy. It is a rather simple option strategy, very easy to learn. It's perfect for the novice options trader, especially if you're coming from the stock trading world, because the wheel strategy, it's really cool. It's a combination strategy of selling options while sometimes holding long shares of stock. So if you already got a portfolio of long shares of stock, the wheel strategy is a great first options strategy for you to try out. So let's go over the basics. What is the wheel option strategy? Well, the wheel, it's a powerful option strategy that is a system of selling cash secured puts and covered calls, which both are typically low risk trades with a high probability of success. Now, if you're brand new to options trading, you're probably wondering, what the hell is a cash secured put? What the hell is a covered call, right? You probably are not familiar with those terms. They're essentially just selling a put is a cash secured put, and selling a call, if you already own stock of the underlying, then that's a covered call. So that's what those are. If I go over to my trading platform, I use TASTYTRADE for my options broker here. And let's say that I'm going to run the wheel on SPY. SPY is the S&P 500 ETF. Well, I would begin by selling a put. So I'm going to sell the 470 put, which is a pretty far out of the money put here. It's all the way down at the 15 delta mark, which means, about 85% of the time, I'm going to be just fine on this. This put will finish out of the money by expiration, and I will get to keep the entire premium that I received for selling that put. I received $190. You can see I received $190 credit for selling the put. All options contracts represent 100 shares of the underlying stock. So the premium I receive is not $1.90. It's actually $190, because we have to multiply everything by 100. And about 85% of the time, I'm just going to be fine here, because SPY's not going to drop below 470. But about 15% of the time, SPY will drop below 470 at expiration. And if that happens, then this put finishes in the money, and that means I will be forced to buy 100 shares of SPY at this 470 price. So now that has happened, let's imagine that I was assigned 100 shares of long SPY at 470. Then what I would do is I would turn around and start selling calls against, SPY is now trading somewhere up here, and now I'm going to sell out of the money calls against my new 100 shares of long SPY. And then as long as SPY doesn't rise above whatever call I happen to sell, the same thing as the put. I get to keep the premium, all the premium I received, but if SPY rises above the call that I sold, then I will be assigned on the call, which means I have to sell 100 shares of SPY at the call strike price, which means my shares are called away and I'm back at square one again. Then I just begin the wheel again by going back to selling puts. That is essentially the wheel strategy. You sell cash secured puts until you're assigned 100 shares of the underlying stock. Then you switch over to selling covered calls until you're assigned and forced to sell your 100 shares of stock. And then you start the wheel all over again by selling cash secured puts. Now, I mentioned earlier the wheel is great for new options traders, especially if you already have a portfolio of stock, because if you already have shares that you can sell covered calls against, that's great. And the wheel does outperform your traditional buy and hold investment strategy, where a lot of people will just take their money. They will buy shares of stock and just hold on to it long term, hold on to it forever. And, that is good passive investment. Like if you don't have time to actively trade, passive investing does work, but you can do better than the measly 9%, 10% gains that the market tends to return on average. For one thing, buy and hold, that only makes money if your stocks go up in price, right? So the buy and hold stock trading strategy, it only works if your shares of stock increase in value. But the wheel option strategy, it makes money if the underlying goes up in price, trades sideways, or even if your underlying stock goes down a little bit, but it goes down not far enough to hurt you. Because remember when I was selling that out of the money put or that out of the money call, whichever one it happens to be, right? I'm selling them far enough out of the money that I have like a 85% chance of being right? It's not like stocks. Stocks are a 50-50 coin flip. It either goes up or it goes down. If it goes up, you make money. If it goes down, you lose money. But with options, you get to define your risk, as I said earlier. And for me, I like to define my risk pretty far out there. I want about an 80% chance of winning. So I put those out of the money cash secured puts. I put them out of the money enough to where if it goes up, I definitely win. But even if the stock doesn't move much, I still win. And even if the stock goes down a little bit, but it doesn't go below my out of the money put, I still make money. So that is the beauty of options. You can make money regardless of the direction that the underlying stock goes. You will sometimes hear people refer to the wheel strategy as the triple income strategy, and that's because you can profit from three different things: from selling puts, from selling calls, and also on the back end of the wheel, when you're doing the covered calls, you also own long shares of stock. And if the stock price goes up, you can make money three different ways. You can make money selling puts, selling calls, and trading the underlying stock. Also, if the underlying stock happens to pay a dividend, you will be paid on the dividend. So it actually makes the wheel a quadruple income strategy. This diagram here shows the wheel in action. We start at the top here. We sell a cash secured put, and we keep selling cash secured puts over and over again until finally one of them finishes in the money, meaning they lose, right? So that put finally loses, it finishes in the money, which means we get assigned 100 shares of long stock. So then we start the back half of the wheel. We sell covered calls, right? And we can keep selling covered calls every month over and over again until finally one of them finishes in the money, which means it loses. It's going to get assigned. When it gets assigned, then our 100 shares of long stock get called away. And now we're back at square one, where we begin selling the cash secured puts again. Let's talk about some things you should consider before you sell your cash secured puts. You should only pick stocks that you would not mind owning for a considerable length of time, because sometimes your puts are going to get assigned, right? You're going to get assigned on your puts, and you're going to have long stock in the underlying company, right? So make sure it's a company that you don't mind holding their shares, right? So it needs to be a profitable company, a company that's not likely to go bankrupt tomorrow, right? So it's very important. This is by far the biggest risk with the wheel strategy, is picking bad companies. So look for companies that are profitable, whose share price has not been in free fall for the last several weeks, several months, or in some cases several years. This is real easy to check out. If you go to a stock chart, for a company, let me go to TASTYTRADE here, and I'm just going to pick a company just at random here. So let's pick Uber. So let's look at the Uber chart here. Now, again, stock trading is not happening. We're after hours on the weekend here, but look at this chart. And that's pretty good. Over the last year, Uber has steadily gone up. that is nice for the wheel strategy, right? This is something I would not mind selling a cash secured put in. Plus, Uber, I have pretty good faith that Uber is going to be around for the long term, right? It's a growing company. It serves a very real need. It's a fresh new industry that's only been around for a few years, and Uber has really kind of been a disruptor in the market as far as it's changed the way that people get food deliveries and groceries and things like that. Uber, I don't mind owning this company, and looking at the chart, it has steadily grown over the last year. Now let me pick a different company, and I'm going to pick one that I know is kind of garbage. Let's look at Peloton. Peloton was a stock that a lot of people traded. It was a real darling during the COVID year because this thing traded. If I go back a few years, this thing was much higher in price. I've got to really adjust the chart to see how high that stock was. But we're talking probably hundreds of dollars at one point. Now it is trading $4.24. And you can see just in the last year, we've gone from $17 to $4. Is this a stock that you want to sell a cash secured put on? Just looking at the chart, right? Not even really knowing anything about the fundamentals of the company. We don't care about that. Just looking at that chart. Is that something that's safe for you to sell a cash secured put on? No, right? Because the stock has just steadily gone down for a number of years now, which means it's going to keep going down. So if you sell a put on it, you're probably going to be assigned shares. And then now you have those shares are going to depreciate in value because, again, the company looks like it's heading to zero. So just be careful picking the right companies. Make sure it's something that you don't mind holding shares of that stock for a considerable length of time. For me personally, I like picking growth stocks. Growth stocks are best because growth stocks are those stocks that tend to outpace the market. They're typically tech stocks. They usually don't pay a dividend because dividends are a drag on stock price. So high dividend paying stocks are usually not great as far as they tend not to appreciate in value as far as the underlying stock. So I like growth stocks. Now, the biggest risk with the wheel, again, is being assigned shares, and then the stock price goes down and never recovers. And that's how you go broke on the wheel. Is you get assigned a whole bunch of shares of an underlying stock, and the stock price never recovers. It just keeps going down, and the whole time you're holding these shares until finally the share price finally reaches zero. So you don't want that. The best way to protect yourself from this sort of scenario is to make sure you sell out of the money puts. Never sell a put that's at the money or very close to at the money, and certainly not a put that's in the money, right? Because when you sell a out of the money put, so if I go back to that SPY put that I had considered earlier, I was going way out here at the 15 delta, right? So I'm going to win on this 85% of the time. So only 15% of the time am I really going to have to worry about this trade. But what if instead of that put, I sell one right here at the money where SPY is currently trading? Well, now this is essentially a 50-50 proposition. I might win, I might not, right? It's a coin flip. And if I do something really dumb and sell a put that's already in the money, well, now I'm going to lose most of the time on this trade. So I'm going to get assigned most of the time on that put. And that's not what we want. We don't want to be assigned. We want to avoid assignment where possible because, again, our biggest risk is being assigned shares and then something bad happens to the underlying stock, right? So the best way to protect yourself, sell out of the money puts. So for me personally, I like selling puts that are around the 16 to 30 delta. I don't like going any closer than 30 delta because that's putting us at risk. And I don't like going out too much further past 16 delta either because then we're not getting paid enough premium on the put. So that's my sweet spot, 16 to 30 delta puts. I sell those puts at 45 days to expiration, 45 DTE, and I manage them at 21 DTE. And this is kind of the Tasty Live rules. So those of you that watch TASTYTRADE / Tasty Live, their content, they always recommend for any option strategies as far as selling options, put them on around the 45 DTE mark, manage them at the 21 DTE mark, meaning if it's winning, take it off at 21 days to expiration. If it's losing, consider rolling it out to the next monthly option cycle so it's back out at the 45 DTE mark, and then when it finally reaches 21 DTE again, manage it again. If it's winning, take it off. If it's losing, consider rolling it again, or whatever it is you need to do. So that's what we're doing. We're doing the 45 DTE, 21 DTE rule. It's essentially the tasty trade mechanics. Ideally, you want to sell your puts when IVR is high, above 30. So IVR, that's IV rank. For those of you using the Tasty Trade platform, IV rank is this number right here next to the ticker symbol for the underlying you're looking to trade. For example, if I go to Shopify here, the IV rank is currently 55. 55 is above 30, and I like Shopify as a company. I wouldn't mind wheeling it, right? I wouldn't mind selling a put somewhere, and go 41 days to expiration is pretty close to 45 DTE. I go to, how about the 17 Delta put here? I'll get a $1.61 credit for selling that put, and I have about a 80% chance of winning on the trade. So only about 20% of the time would I even have to worry about managing a losing trade. So that is the mechanics for selling cash secured puts. Let's go to covered calls. So the way a covered call works is now you've been assigned on your put. Now you're long 100 shares of the underlying stock, right? But this is not necessarily a bad thing. Even though I said we want to avoid assignment, sometimes you're going to be assigned. It's just part of the deal. But remember, we prepared for this. We set aside cash when we sold our cash secured put, right? We made sure we had the necessary cash to cover that assignment so we could buy the stock. And now that we own the stock, what are we going to do? Well, we're going to sell calls against it. First thing you need to do, though, you need to determine your cost per share on the stock that you now own. So what you need to do is add up all the credits that you've received so far from selling puts. So if you've sold 6 different puts at various different credits received, add all of those up and then subtract those from the cost per share, right? So your cost per share is going to be lower than what you were assigned at. So because you received credits. That's one of the beautiful things about the wheel strategy is that typically your cost per share on the stock is actually quite a bit lower than what you were assigned at. For example, if you were assigned 100 shares of ABC stock at $70, but you'd receive $350 in total premium from selling puts, then what's your actual cost per share? Well, it's actually $66.50, right? Not $70. So that's great. Matter of fact, if $66.50 is your current cost per share and ABC stock is actually trading at, say, $68, you're actually up on the trade, right? Even though you were assigned, just because of all the premium you received from selling the puts before, you could actually close the position out right now and still be up. Now, very similar to selling cash secured puts, I like to sell my covered calls at the 16 to 30 delta mark. So I don't do 45 DTE for selling covered calls. I like things to be a little shorter because with covered calls, a lot of times you take them all the way to expiration. And you do that because a lot of times you want to unload those shares. You want to get assigned, right? So the best way to get assigned is to take it to expiration and hopefully have it finish in the money and have those shares called away. So I don't want to be doing that over a 45-day time span. Right? So I like something a little shorter. I like selling covered calls around the 14 to 21 DTE mark. So I'm going out 2 to 3 weeks. So I'll sell 21 DTE covered call, and typically I manage them around 7 DTE a week out. So if I already reached 50% max profit by the 7 DTE mark, meaning we still got a week to go, but I've already made 50% of my profit, I'll go ahead and close the call for a winner, or I'll roll it out to the next month or whatever it happens to be. But if I don't make my 50% profit by 7 DTE, I'm just going to let it go all the way to expiration. I'm just going to let it go. I'll receive 100% of the premium if I let it go. Plus, if it happens to finish in the money, I'll have my shares called away, which a lot of times I want, because personally, I don't like the risk of holding on to long shares of stock, so I don't mind my covered calls getting assigned. So let's go over an example of a wheel trade. So let's say ABC stock is trading at 102.25, and you begin the wheel, of course, by selling a put. We sell the 95 put. So it's trading at 102.25. We sell the 95 put with 35 DTE for a credit of 275. The put is at the 25 delta mark, meaning we're going to win about 75% of the time. We're going to be tested on it about 25% of the time. So at expiration, ABC is now trading at 93.75. So it's gone down in price. So 93.75, that's below the 95 put strike. So we get assigned 100 shares at 95 per share. So are we currently up or are we currently down money? Are we up money or are we down money on the position right now? Well, actually, we're up a little money because we collected $275 in premium. Remember, we received a credit of $275 times 100 because the options contract represents 100 shares. So we collected $275 when we sold the put initially. And since we were assigned on the put, we got to keep all of that money. And then we had to pay $9,500 to buy 100 shares of the stock, but the stock is currently trading at $93.75. So we're actually down $125 on the long stock position. So we're actually up $150 so far on the total position because we made $275 on the option. We lost $125 on the stock so far, but total, we're still up $150. So now we go ahead and move to the back half of the wheel. So now we have the 100 shares of long stock of ABC stock, right? Now we sell a covered call against those long shares. We sell the 105 call. Remember, ABC is trading around $93. We sell the 105 call. So it's an out of the money call with 35 DTE, and we get a premium. We receive a credit of $3.05. Now the delta is 30. 30 delta means we're going to win about 70% of the time. We're going to lose about 30% of the time on the call. Expiration rolls around, and as luck would have it, ABC stock is currently trading at 102.50. So it's really risen, right? Because it was at 93 on the previous slide. Now it's at 102.50. So what is our P&L on the trade now? So if you remember from the previous slide, we had collected $275 premium from selling the put. Now we collected $305 in premium by selling the call. Since the call expired worthless, we keep 100% of the premium. Since the put expired worthless because it finished in the money, we got to keep 100% of the premium of that. So in total, we've got $580 just in options premium during this trade. Plus the 100 shares that we purchased of ABC at 95 per share earlier, they're now trading at 102.50 per share. That's an increase of $7.50 per share. So that's a total increase of $750. So now we're up $1,330 total on the position because it's $275 plus $305 plus that should be $750, not $700. I'll correct that after the video, but the total is right, $1,330. And I couldn't stand that little typo there, so I went ahead and corrected the slide. So $275 for the put premium, $305 for the call premium, plus $750 we made on the increase of the stock for a total of $1,330 total profit on the trade. So I hope you guys enjoyed this video. If you're new to options trading, trust me, now all of this may seem complicated. It's not. It's one of those things you just have to do it. You got to get in there, do it for a little while, make some trades. And by making some trades, I mean you're going to have to make hundreds of trades before you really know what you're doing. Sometimes you might have to make thousands of trades before you really know what you're doing. So just make sure that when you're trading, if you begin doing this, make sure you trade small, right? Don't trade big numbers. Don't take on huge position sizes. For those of you wanting a little more information about the wheel strategy, I have written a book on the wheel strategy called the Super Wheel Options Strategy, which is available on Amazon. So check that out if you're interested. Link in the description. All right, guys. Peace.